Dobrý den, dámy a pánové, vám přeje partner poradenské společnosti Save & Capital, globální strateg Roman Chlupatý. V rámci příprav na letošní investiční fórum jsem diskutoval s hlavním globálním analytikem Invesco Paulem Jacksonem, jak a proč vypadá jeho vítězné portfolio na rok 2024. A právě tuto debatu v nezkrácené podobě vám nyní v rámci našich lednových speciálů nabízíme. Na úvod se Paul zamyslel nad tím, co by mohlo ty takzvané středové scénáře, tedy očekávání většiny trhu, že se hlavní ekonomiky odrazí ode dna a velké centrální banky budou snižovat sazby, změnit.
Well, I think there are a number of things that could go wrong. First of all, perhaps central banks have already tightened too much, and that we haven't yet seen the full effect of the tightening on economies, and that we get a much deeper slowdown and recession than is currently expected by markets. And I think under that sort of scenario, central banks would be cutting rates, but they would cut them much more sharply. But also it would be the defensive assets that would perform better and cyclical assets would underperform. So assets such as equities and high yield, I think, would suffer under that sort of scenario. I guess the other way that things could go wrong is you have maybe some sort of geopolitical accident, something like the situation in the Middle East. It worsens, it broadens, we get a big jump in the oil price, inflation goes back up, and central banks actually, rather than easing, have to tighten. And so we might even get a rerun of 2022 under that sort of scenario.
To what extent might be the elections the sort of a trigger of some sort of a crisis, or at least turbulences? Just a reminder for those who are not aware of it, we're expecting 40 plus elections, some of them, let me say, systemically important, such as the US elections in India, Taiwan, South Africa. Is it something that you watch, or you're going to watch, something that can actually impact the market?
Well, I think like everybody, I'm fascinated by elections and by the political situation. In truth, elections don't normally have a big effect on financial markets, or not a durable effect. They can certainly bring volatility, but that usually passes fairly quickly. However, there can be exceptions. For example, the election in Taiwan in January, if there were a new president, there will be a new president, but if the president were from the side of Taiwan that favors reunification with China, then that could change the balance of that relationship between Taiwan and China. However, opinion polls suggest that will not happen, that there will be a continuity presidency. Indian elections, I think they could be important, but I think it's almost a foregone conclusion that Modi will once again win. There are elections in Russia and Ukraine, apparently, but Russia, we know who will win. Ukraine, it's unlikely that the elections will happen. But the big election this year is, of course, in the United States. And there we have the possibility of a return of Donald Trump to the White House. That, I think, will bring volatility in terms of psychology. I think it could be quite a disturbing possibility. Whether it is going to be upsetting for markets is to be seen. It wasn't last time, but I think around that election, especially if it's a close result and the result is challenged, then that could bring a bit of short-term volatility. But I wouldn't think of it as being a sort of strategically important outcome.
One more political, or rather geopolitical question, and that is decoupling between China and the US, that of course has its own outcomes. Of course, we have countries that benefit. India, you already mentioned, but also Vietnam, Indonesia, and some smaller countries, Mexico as well. And we have a negative impact on both big economies in certain aspects, certain segments on the other hand. How do you read this story? How it's going to unfold in 24, and what should we watch in particular?
I almost feel as though we may have passed the worst point on this. I think that China and the US are trying to improve relations. Of course, the election in the US may complicate matters, but I think we've kind of passed the darkest moment, which is not to say that there will still not be some sort of movement of productive capability away from China. But the Chinese actually started that. The Chinese started investing in surrounding countries. You mentioned Vietnam. They started that process because it is cheaper to produce in those countries than in China. So this is not a new phenomenon. The movement to somewhere like Mexico, I think, is a logical move for supplying the US. So I think that companies in general will always use the profit motive to choose where they are going to locate their production. If it is better to be located in China, I think they will continue to do that. But naturally, as economies progress, they will seek other places and maybe a more diverse range of places to produce. So I think it's just an ongoing part of an economic process. I don't think it is going to bring a sort of catalyst for big volatility during 2024. I think we've seen that to some extent already. And to be honest, it hasn't had a massive impact. And I suspect the Chinese economy is now improving. It will have better momentum than the US. Chinese stocks are actually very cheap at the moment. So I think that the Chinese stock market could do quite well in 2024.
Okay, any nasty surprises, let me put it this way, black swans aside, how should we model the winning portfolio, if you will? How would you structure a portfolio for 2024, given all the macro stuff and other things we already addressed?
Well, my model asset allocation, assuming that interest rates come down and come down quite rapidly, that economies are slowing in the short term, but will then recover later in the year, my model asset allocation is now seeking more risk. So I have zero cash. So I have reduced the cash position. I have a maximum allocation to investment grade credit around the world. And that is, I'm using investment grade credit as my defensive fixed income asset. I prefer it to government bonds where I'm slightly underweight. So investment grade credit, I'm at the maximum allocation that I allow myself. And particularly within investment grade, I favor emerging markets. I'm also overweight high yield, which I think could be a little bit volatile in the short term. But as the year progresses, I think the returns on high yield will be reasonable. The same applies to bank loans. So I'm overweight both high yield and bank loans. I'm also now more, I guess, embracing risk. I'm overweight real estate, which clearly has fundamental problems, but I think a lot is already in the price. And as interest rates come down, I would expect real estate assets to benefit from that decline in rates. Elsewhere, I'm underweight equities, but that is largely because I think the US market is very expensive. And the US is a big part of the global index. So if I'm going to be underweight US equities, I'm pretty much forced to be underweight global equities. But within equities, I prefer Europe. I prefer emerging markets. I've already mentioned that I like China. And finally, commodities. I think in a slowing global economy in the short term, I think industrial commodity prices will come down. So I'm zero allocated to commodities, but I would expect the price performance to improve towards the end of 2024. So favoring credit, favoring real estate, bank loans, and from a regional perspective, favoring European and emerging market assets.
When it comes to stocks, the big theme of 2023 was, of course, the technological sector and artificial intelligence in particular. What do you think about that story? Is it going to continue? Does it make sense to make an exception to how you describe your portfolio and thinking for 24 and still try to get some winners, pick some winners from that realm?
I think that artificial intelligence is obviously going to be a theme, not just for the markets, but for economies for some time. It strikes me that this is an important, it's not a new technology, it's been with us for decades, but there have been new developments which have made it much more exciting. So far, and this usually always happens, it's the enablers of the technology that have benefited. So the shares that have gone up, the share price movement has been in the people developing the tools, in the people providing the data that educate the tools, and the companies that provide the semiconductors that are needed. So those enablers of artificial intelligence have been the ones that have benefited. I think they have moved a lot, and I think with that there being there is no credit bubble at the moment. So I think there is a limit to how far that artificial intelligence bubble can go under current circumstances. But what I'm more interested in is the broadening out of the benefit from the enablers to the users of artificial intelligence. Usually that's a process that can take decades. When you look at industrial revolutions in the past, it takes quite a long time for us to understand how to best utilize new technologies and for the world as a whole to benefit. I think now these technological cycles are getting shortened. And perhaps one of the biggest hopes, and if you're looking for a soft landing scenario for 2024, where we get this kind of Goldilocks reacceleration of economies without inflation, it might be that artificial intelligence enables productivity growth to increase. And we have had very low productivity growth since the financial crisis. If artificial intelligence does deliver on productivity, then everybody at a broad macroeconomic level, but in terms of a broad range of companies, could get some benefit from that. And that broadening out is what I think is going to be the really interesting part of this. So I'm not necessarily chasing the things that have done very well this year, but looking for perhaps some hope that it can deliver an even better economic outcome than I'm expecting.
Many investors, both institutional and small retail investors, do not like Europe, do not like the outlook, despite what was happening in 23. For instance, stock markets performed very well. You said that you do like Europe. So what in particular do you like?
I think there are two things. First of all, there is a price for everything. So, you know, even when the fundamentals are bad, if the price is low enough, then that can still be a good investment. And in fact, can be a better investment than something that you really like, but where the price is very high. So I think, you know, European equity prices are a lot cheaper than in the US, cheaper than somewhere like India. But the other thing for Europe that I think is going to be attractive as interest rates come down and as economies recover is that the European economy is in a worse place than the United States. So it has more to benefit, more to gain from the upswing and the reduction in interest rates. Also, the European stock market has many more what we would call value companies, as opposed to the growth stocks in the US. And those value companies, you know, they become cheap, people ignore them, and then they deliver good returns in the future. And I think as interest rates come down, we should be seeking out those companies that perhaps have been the most under pressure as a result of higher interest rates. So we're looking for where the relief is going to be the greatest. And I would expect yield curves to steepen. Banks tend to do better when yield curves steepen. Europe has got a lot of banks. Real estate, I think, will benefit. But Europe has a lot of these kind of values. We talk about, if we want to be pejorative, we talk about when economies recover and equity cycles start, we talk about a dash for trash. And Europe has more of that trash, to use a slang term, than, say, the United States does. So I would expect Europe to benefit from that. It's cheap and it's got the sort of companies that will benefit more from the recovery.
We addressed the do's, let's say, investment do's for 24 throughout this interview. So let's focus on don'ts, the stuff that you at the moment wouldn't, quote unquote, touch, you wouldn't recommend. What are those?
Well, listen, I don't look at cryptocurrencies, for example. I believe in the John Paulson view. I think John Paulson once said that when he was being interviewed about this, that, yeah, cryptocurrencies, there's a limited supply, but it's a limited supply of nothing. I find it's an asset that is very difficult to analyze. I can't analyze it, therefore I don't invest it. And I personally speaking, I wouldn't touch it. I'm typically when looking at investments, I'm trying to buy low and sell high, which is what, it's a very simple thing to say. It's not so easy to do. But when companies have been doing extremely well, when their share prices have been going up a lot, I think it's hard for that to be repeated. And that makes me a little bit wary about market capitalization weighted access to the US stock market, for example. So if I'm looking at the US, I would maybe look at a more equally weighted version. So I'm not getting forced to buy lots of companies that have already done extremely well. So I think, those are two things that I would look at avoiding. I'm always avoiding cryptocurrency, and I'm always avoiding things that I think have done extremely well and that have made them therefore expensive. And for me at the moment, it is that kind of magnificent seven in the US. And looking at the US, I would take a more balanced, equally weighted approach.
To bylo vítězné portfolio na rok 2024 z dílny hlavního globálního analytika společnosti Invesco Paula Jacksona. Už 29. vám na prvním semináři tohoto roku své vítězné portfolio představí portfolio manažer Top Stocks Jan Hájek. Mrkněte na stránky vítěznéportfolio.cz, pokud se chcete dozvědět podrobnosti. A to je pro dnešek vše. Vše dobré, nejen na trhu, vám přeje partner Save Capital, globální stratég Roman Chlupatý.